Okay, so we are going to put these transactions into our T accounts. These are the T accounts that we're going to be using. We have cash, supplies, prepaid insurance, accounts payable, Supply Depot, and Johnson Capital. So first we're going to label the debit and credit side of each one and the normal balance side because that'll help us out. So if we remember, the left side is always the debit and the right side is always the credit. So for cash, we have debit and credit. Cash is an asset, so it has a normal balance on the debit side. If we go over here to supplies, we're going to have debit, credit, and supplies is an asset, so we are going to have a normal balance on the debit side. Prepaid insurance, debit, credit, and prepaid insurance is also an asset, so a normal balance here on the debit side. Okay, down to accounts payable, Supply Depot, which is a liability. Debit is still on the left, credit is still on the right, but the normal balance is now a credit. And for Johnson Capital, debit left, credit right. The normal balance side for the capital account is the credit. And if you remember, the normal balance side is the side in which the account would increase. So, looking at May 1st, we are paying cash for supplies. So if we're paying cash, our cash is going to go down. So we're going to come over here, we're going to label May 1st. And because cash is decreasing, we want to put that on the credit side because it's not increasing, so it's not going to go on the normal balance side. So we put 200 over here. And again, you don't need a plus or a minus, it's just a debit or a credit. If we purchased supplies, then that means our supplies account is going up. So we want to put our supplies a $200 on the debit side. Okay, so we have our debit and our credit. So we paid cash for supplies, so cash is a credit, supplies is a debit. May 2nd, we are receiving cash from the owner as an investment. So if we received cash, we're going to increase our cash. So May 2nd, if we're increasing cash, then it's going to go on our normal balance side, which for cash is a debit. We put $3,000 on the debit side for cash. And then we need to go down to our capital account. We'll go down to our capital account, May 2nd, and our capital is also increasing, but a capital increases on the credit side. So we'll put the $3,000 over here. So again, we have $3,000 in debit, $3,000 in credit, so our debits equal our credits, and that is a good thing. May 3rd, we bought supplies on account from Supply Depot. Okay, so if we're buying supplies on account, cash is not being used. We are receiving some more supplies, so our supplies balance is going to go up. So May 3rd, if our supplies balance is going up, we want to put that on our normal balance side, which for supplies is a debit. We have $750 for supplies. We are also going to increase the amount in which we owe Supply Depot. So May 3rd, a liability account increases on the credit side, so we'll put our $750 there. And our debits equal our credits. Okay, May 4th. We paid cash on account to Supply Depot. So we're making a payment to Supply Depot. We are paying them some money, which means our cash account is going to go down. So we want to put it not on the normal balance side. We want to put it on the credit side, $550. And then down here to accounts payable, Supply Depot, we want to put that on the debit side because we're also decreasing that balance of what we owe them. So we have $550 as a credit for cash and $550 as a debit for accounts payable, Supply Depot. May 5th, we are paying cash for supplies, so we're buying supplies with cash. So if we're buying supplies, we are decreasing our cash, so we're going to put this on the credit side, $250, but we are also increasing our supply balance, so that's going to go on the debit side for supplies, $250. Okay, May 10th, pay cash for insurance. So it's going to decrease our cash. That's going to go on the credit side. But it's going to increase our balance of prepaid insurance. Prepaid insurance is an asset, so it has a normal balance on the debit side. So that's our increasing sign. So we'll put that as a debit. May 11th, we are paying cash on account to Supply Depot. So we're making another payment to Supply Depot. We are going to decrease our cash, so that's going to have to go on the credit side for cash. We're also decreasing the amount of money that we owe to Supply Depot, so that will go on the debit side for supply accounts payable to Supply Depot. May 14th, we're buying some more insurance, so paid cash for insurance. So our cash is decreasing, so that's going to go on the credit side. And the balance of our prepaid insurance is increasing, so we're going to put that on the debit side. May 24th, we're buying supplies on account from Supply Depot, so we're getting more supplies. We're not paying any cash for it right now. So our supplies balance is going to increase. So that is going to go on the debit side because it's the normal balance sign. So $1,500 on the debit side for supplies. We are also increasing the amount of money that we owe Supply Depot. So May 24th. The increasing side of a liability account is the credit side, so we put the $1,500 on the credit side. And our last one, May 30th, received cash from owner as an investment. So we received cash, so that's going to increase our cash. Cash is an asset, so we're going to put that on the debit side, $2,000. And then it's also going to increase our capital account as well. Capital accounts are increased on the credit side, so we will put that on the credit side for Johnson Capital. You need to now complete your on your own exercise.